February 19th, 2020. And at this time, I'd like to turn the meeting over to Ms. Katrina Stauffer.
We're going to begin with the nominations for chair.
I so move.
We have to do our nominations for chair and the nominations for secretary, and then we'll do the meeting roll call. So from Chair Michael Spitzer?
Absolutely.
Okay.
Call the vote.
Okay, so we're going to call the vote. Hearing no other, then Michael Spitzer would be the chair? Yeah? Wonderful.
Thank you. At this time, I'd like to have a nomination for secretary.
Nominate whoever you want.
I'll nominate Katrina Stauffer. And by the way, welcome back.
Just make sure one of you.
Okay, hearing no other nominations for secretary, congratulations. At this time, okay. What we're going through is housekeeping or administrative things for the audit committee. At this time, I'd like to turn the meeting over to Katrina Stauffer to call the roll.
So we'll start with our private members. Michael Spitzer, chair.
Present.
Larry and Angela.
Present.
Mark Kaplan.
Here.
Bud Larson.
Here.
Our public members, representing Mayor Bill de Blasio, Raymond Lee.
Present.
Representing Comptroller Scott Stringer, Jacqueline Thompson.
Present.
Representing Public Advocate Jamani Williams, Michael Toomey.
Here.
We have a quorum.
Thank you. In the package was the bylaws. So what we have to do is adopt the bylaws. So I'd like to have a motion to adopt the bylaws of the audit committee.
I make a motion to adopt the bylaws.
I confess I had some comments, but I left them home. Will you accept them with a little bit here and
Okay, we'll accept them subject to minor modifications. Next up on the agenda is the acceptance of the meeting minutes of January 22nd, 2020.
Move to accept.
Second.
Okay, we'll accept the minutes subject to minor modifications. Mark always hands in modifications.
This time was okay. No, I take it back.
Also in the package is the annual report of the audit committee. And briefly what that does, it spells out all the activities that the audit committee had over the course of the 2019-2020 year. So I'd like to have a motion to accept the annual report.
Motion to accept.
There is some changes I'd like to suggest. I won't hold everybody up, okay?
Okay, we'll accept the annual report subject to some minor modifications. Okay, now we get to the agenda. So the first thing up is the City of New York's management letter. So I'll turn this over to Grant Thornton. Mm-hmm.
Do you want to look on?
No, I've got it here. But I'm minutes and bylaw comments.
Just ask the Department of Finance to speak to the recommendations and how they plan to have a comment.
Okay.
It's a very short letter.
It is a very short letter. That's a good thing.
We want a new partner.
Done.
I gave you a line.
Yeah, first, we're going to have a presentation from Grant Thornton, and then the representative of Department of Finance is here. So when it comes to their comment, the person from finance will have the opportunity to discuss it.
Very good, very good. So as you may recall from previous years, we have issued a no material weakness letter with respect to financial reporting for the citywide financial statements. This year, for financial reporting purposes, we did not identify any material weaknesses or significant deficiencies that we felt were necessary to bring to your attention or to include in a written report. We do have one matter that we did want to bring to your attention, and that was the one finding that's included in the letter that you see. And this has to do with the implementation of a new software tool that was used by finance for purposes of tracking and recording property tax revenue. So the system went live in the spring of 2019, so it was live for approximately 3 months during fiscal year 2019. During that time, most of what the system was asked to do worked just fine. There were a couple of nuances, one being the calculation and processing of refunds. That did not happen the way that it had previously. This was identified by DOF, and they did what they needed to do in order to do the calculations. They ultimately did make the remittances. They just weren't done in a timely manner. And the amounts and the method of processing between the new system and FMS, the city's general ledger, didn't work through the voucher system the way that was intended by the city's processes and procedures. What we did identify was that finance identified the issues and that they had ultimately made the entries that were necessary. So in the financial statements for the year ended June 30, 2019, refunds were appropriately reflected, property tax revenue was appropriately reflected, so there were no misstatements that were identified from a financial reporting perspective. It's the processing and the controls that were not quite where we would want them to be from a citywide perspective.
Has the city taken steps to close that gap?
I'll let finance speak to that.
For the record, just please identify yourself and the organization that you're here from.
Hi, I'm Sue Wang from FIT for Department of Finance. The current FIT is actually aggressively testing for the PTS reconciliation. The target production date is 2/28.
So if I interpret that correctly, by the end of this month, the system should be working the way it's supposed to.
That is correct, sir.
Thank you. Sorry.
And you did indicate the Department of Finance recognized the error on their own operations?
They did. They made subsequent reconciliations.
So it was they recognized it, and it wasn't something that was picked up in an audit and they were told about, they knew about it?
We identified it during our testing procedures, and when we made inquiries, they told us that they had identified it and made the corrections. So a little bit of both.
Okay, thank you.
That's good, working in partnership.
Absolutely.
Keyword partnership.
Word of the day.
That's it for the city's manager.
That's it for the citywide letter.
Thank you
Yes.
for coming.
Thank you.
At this time, I'd like to call on the New York City School Support Services Agency. We're doing DOE after everything else, single order. These guys.
Mark Kaplan. I can't hear you.
Well, I tell you what, I'm in the middle of a meeting. Would you mind calling me later? I don't know who that was.
Good morning. Could you please identify yourselves and your auditors and everybody that's here with you?
Sure. I'll start. John Shea, CEO of School Facilities, New York City Department of Education.
Brooke Lewis, CFO, New York City School Support Services.
Stephen Brennan, Executive Director, NYC School Support Services.
Mark David, I'm Director of Finance of School Facilities.
Phil Napolitano, Director of Field Operations, School Facilities.
Warren Rupel, the engagement partner for Marks Paneth.
Thank you. Would you like to make some opening remarks?
5 to 1.
No? I believe our audit speaks for itself and what we've provided.
There's no comments about the activities or what's been going on?
Well, we continue to work with the DOE on providing data.
One of the things you got to remember, there are some new members of the audit committee, so any presentation that you've made in the past, the people here wouldn't know.
Oh,
Sure. You want me to?
if you'd like, sure.
Sure. So just for the new members, although some of you might know already, New York City Department of Education in 2016 moved from what was known as the old custodial indirect system, where custodians were quasi-independent contractors and hired and fired their own employees and managed their own budgets, to a system where all of the employees of those custodians were consolidated under a not-for-profit New York City School Support Services, who provides all of the payroll, discipline, and human resources management for all of the people that work, all of the people that work for the custodians in our schools. New York City custodians are still DOE city employees. The people that work for them are all employees of New York City School Support Services. We did that for a variety of reasons, all of them good, and I am happy to report that we continue to meet our goals of cost neutrality, and we're hoping to continue to move towards even some cost savings as we go forward. Even though our portfolio continues to grow and costs continue to increase, our hours are down and our efficiencies are up, and I think the partnership between the city, the collective bargaining units that we deal with, Local 94 and 32BJ, and the Department of Ed itself, it's been a great partnership. We have seen services increase, we've seen efficiencies increase, so it's in the 4th year now that we're going into, and it's been a great partnership. So.
Has anybody ever performed a cost analysis for what the old costs were, but the way that it was operating then to what the new costs are today?
So we've done it in a variety of ways, and we can provide the committee with however you want to see it. I don't know if, Brooke, you want to talk in general about some of the costs from the old system to the new system?
Yeah, I mean, it's really hard to compare apples to apples because when we went to the new system or when we were created, it went to prevailing wage, whereas previously under the old system, about 80% was not under prevailing wage. So there was a significant increase that way. But if you were to compare, and this is more on the DOE side, but the hours and everything else like that, it's more in line, as well as finding efficiencies now that we're all under one roof. So being able to utilize, previously part-time employees, convert them to full-time and have more efficiencies that way and having the savings that way, as well as being able to direct employees working under one roof to multiple schools to find the efficiencies that way.
And overall, as I said earlier, even though our portfolio continues to grow, we continually have conversations with the Office of Management and Budget on the calculation of what constitutes cost neutrality, and we agree that the budget money that we get from OMB is sufficient to meet our needs, and we have been able to meet our budget every year in the existence of NYSIS.
Have you been able? I was the head of the audit committee of the Board of Ed years ago when the custodians ran rampant with things that went wrong. Is that pretty much eradicated now? No more shooting galleries in the basement, no more people.
I'm not going to say that we don't have issues, but the corruption to which you refer, I believe, is completely eliminated. Under this system, we have so much more control. Custodial supplies are all handled centrally. Custodians have very limited ability to go out and buy things on their own. The stuff that you would read in the papers about the Jeeps and the vehicles and the equipment.
That's over?
That's over. That's totally under our control. Custodians are effectively managers and city employees, no different than anybody else. And they don't have the financial independence and personal fiscal responsibility that they used to have. That's now all residing with the Department of Ed.
Vast improvement.
I concur.
In the audited financial statements, it said that the contract ends June 30th with a one-year renewal. What's the current status of that contract?
So the contract was passed by our panel for educational policy at their last meeting in January. When we have the ability to send the contract over to OMB and to the Comptroller's Office for review and approval in May, we will do that, and we expected to have it in place so that by July 1st we can meet our first payroll under the new contract.
How long would the new contract be?
That is an 8-year contract with 2 one-year renewals.
So roughly it could be 10 years.
Yes.
Okay.
I have a couple of questions on your footnotes. First of all, I think something's wrong here, because it says in the paragraph, first paragraph, note 1, it says that nice as follows, as due to the appointment is an MENT.
We can't hear you.
I'm sorry. In the first paragraph of note 1, there's something wrong in the 4th line from the bottom. Take a look at the language. You don't, due to the appointment of the board, that's picayune. You also indicate in the second paragraph of note 2 that revenue subject to accrual, which is when it becomes measurable and available to finance expenditures in the current year. The next sentence says revenues are considered available if expected to be received with 1 year of the year end. And that's a little odd. You can treat it as revenue if it's a year later when you get it. And when you say it's available to finance expenditures in the current fiscal year.
Yeah, so when it comes to year end, we end up having to do an accrual based off, the way that payroll
Right.
sits. And it's most often we don't get the revenue or actually get the exact funds or the funds until the following year.
Well, okay.
That's the period of availability of. that
I
they've chosen
understand. I
for
just
it,
don't
yeah.
think the language is felicitous. Sorry. Now, this is a general question. Each of these units has a footnote relating to new accounting pronouncements. I didn't read one against the other. They all the same in all the financial statements?
No.
Yes, for the ones that we audit, they're
Yeah,
consistent.
okay. Then you have in note 3 a whole discussion of inputs. You don't have any at the level that you're talking about. Why do you have all that language? As I read this thing, you only have money market funds, nothing else. So, just point out, there's a lot of.
Well, it's an accounting, an accounting.
I know
you
it
have
is,
to
but
explain
it's-
what the policy is for the different levels before you can tell people that they're all level
It's
1.
irrelevant. Yeah, you
I
know
know.
that one. Now, I'm on page 18, now 19. In footnote 5, there's a reference to the fund is shared, a multiple employee defined benefit by Director of Retirement Services. Who is that, the Director of Retirement Services? Is that one of your employees or somebody else's?
So this is under 32BJ, which is a union, so we don't administer the pension plan. It's through the union itself.
All right,
And-
so the Director of Retirement Services is not an employee of yours?
Correct. This is all 32BJ and the union of 32BJ.
I think that if you read this, you can't tell who he or she works for. I don't know how important that is, but. Then the last sentence in the second paragraph says, for participants to 30 or more pension credit, an additional $100 advanced added to the benefit. Is that per year, per month, for what? I couldn't tell.
I believe that's per year. I'm sorry, per month.
Well, I think maybe you should make that plain, because it's a big difference in money. Let me take you to my other pet peeve. On
We'll
page,
pull it out of the retirement pamphlet from 32B, Joe.
okay, page 21, your investment rate of return is 7.25%. If I look at the table down below of what long-term expected real rates of return are, nothing comes up to 7%, much less 7.25. How do I get for investment rate of return there down to the actual rate of what you're expecting? There's a 100 basis points difference, at least.
Well, the amounts that are in the table are the real rates of return. The 7.25% is total, which would include inflation.
So in terms of what you expect, if the real rate of return is down on the bottom of page 21, then how can you use the 7.25 for the purposes of figuring out what you need to spend?
We're not using those numbers. That's the pension itself that's using those numbers in conjunction with the actuaries to rate the fund. So the management of the pension fund uses a 7.25% return. The actuaries use that in their evaluation of the health of the fund as we move forward. The numbers that you see below are the actual returns, I believe, from 2018, which had the downturn of the last month in 2018. So
Well, it says long-term rate of return, so it wouldn't be based on one year.
what they normally do here is they blend these out, these returns. So when you're dealing with pension funds, it gets blended out over a longer period of time.
No,
So this is their expected growth, excuse me, over the next 20 to 30 years.
that's the long-term expected real rate of return.
Of the 7.25% is what the basis of the math comes from. And again, that's not us managing that.
No, I understand.
That's 32BJ managing their fund.
I understand that, but what you're having here is the fund is using an investment rate of return of 7.25%. The actual return, what they actually expect, is much less.
That's a snapshot of a fiscal year of
Which is the
returns.
snapshot, the long-term one?
When under the asset class target allocation, the long-term expected real rate of return, I'm not sure where those numbers came from.
Those are that's kind of going back to what I said before. Those don't reflect an inflation component, where the 7.2% does reflect an inflation component.
They're not on the same basis.
They're
These
not on
two
the same
numbers.
basis,
One-
right.
One is the full return, and the other one is, quote, the real return,
Correct.
netting out the inflation.
I think I understand that, but I think somebody ought to try to make it plain to an ordinary reader how you square those two numbers.
Yeah, I mean, there's some additional language could be put into to indicate
Nobody
that,
else, it's just that I always have trouble with that. And then, I'll give you the little stuff, as usual, Warren. I don't have anything else. Oh, I have one overarching question. How do your current rates for the maintenance of the system, which is what these people do, compare to other systems, adjusting for the fact that New York City is expensive? Do you do any comparative studies to see how much it costs to maintain one of your buildings compared to someplace else?
On any basis, whether it's the cleaning or the maintenance side, we are significantly lower than other major urban school districts across the country.
Wow.
Some of that's economy of scale, some of that's because we got some really good people.
My congratulations. I was there when it wasn't so.
Just a quick question back on the pension fund. The assumption of the 7.25, is that, are you aware of whether that's on the same or different basis than the city's general 7% assumption for their pension funds?
They're not integrated at all, that two.
No, I know they're not integrated. I'm just asking because the city generally reflects a 7% assumption for the rate of return for their pension funds. So I'm wondering if this number is a different basis than our city number.
Yes.
No, I mean in terms of like, you know, you're talking about like inflation adjusted versus not inflation adjusted.
The city's 7%. They've done their actuarial analysis to determine they're going to use a 0.25% higher.
Right.
The city does.
I know. I'm wondering if, we're making an assumption about investments at 7%. 7.25 is higher than what we're assuming. We're wondering if there's a reason for that.
Well, there's different investment pools. So, the actuaries make a judgment as to along with the management of the plan, as to what they think the expected long-term rate, including inflation, of the plan will be, and that's the rate they use. It's not unusual for rates to be off, a percentage point or so, based upon the actual assets that are invested.
Okay, thank you.
Let me follow up on that, because I think you're right. You got your finger on something. Why should different elements of the city use different assumptions? After all, it's one city. Why should one plan have one assumption and another plan have a second?
It's not the city's plan. It's through 32BJ. It's a completely separate pension plan.
I understand that. But in the end, the city pays into the plan. Why should the assumptions be different for two plans, both of which ended up in the city's lap?
I think that would have to do with how this was formatted in the first place. 32B&J is an independent, much larger plan than the city. So once you've made the decision that you're going to have these employees represented and their pension's going to be 32B&J, not taken on as part of the city's overall pension liability, I don't think the city would have the place to go into 32B&J and tell them to change their interest rates across the board for a very large system that includes a lot more than just the city of New York. We're in this case, we're a small component of 32B&J.
Oh.
We're the tail here.
Okay.
So I think it would be difficult to go in and tell them, you've got to change what you've agreed to with all your employees across all the maintenance across the city to match what the city's using. I mean, you've made the decision by setting up this structure that they would be in 32BJ. That would be part of that decision means you're going to accept the fact that you could potentially have that difference.
Larry?
Yeah, if we can just go back for a minute to the added efficiency with the changeover. Thanks. It was, it was a major change to create this organization and shift all of the custodial workers, if not the custodians, into this system with the thought of having more transparency and more efficiency. And I know it was, I know very well that it was stood up at a very kind of quick way to get it up and running. But now that you've had a few years to stabilize, I think it would be a good idea before your data, before your existence gets like lost in the mists of time, to actually run some numbers that show or demonstrate the efficiencies and transparencies you have, because this was a huge, huge change for the city. So it would be good to see the fruits of it.
Shirley.
If there are no other questions or comments, thank you for coming this morning.
Thank you.
Thanks. Have a good day.
Well, what we used to see.
Next up on the agenda is the Educational Construction Fund, otherwise known as ECF.
And the way people worked on this.
The fact that any custodians payroll might be on the back of the napkin, in and of itself, even if
It was
nothing bad
terrible.
was done.
It was terrible.
So that's way much better.
Yeah, they got their own cars.
Yeah. Oh, I claim some credit for raising hell when I was on the audit committee of the board of
They
ed.
hired their own family members.
Terrible. And they sold drugs in the basement.
So
They manufactured them probably too.
That I didn't know. Well, when they told us they were shooting galleries, I misunderstood the comment.
I thought they were like they had
Bang,
guns.
bang.
Yeah, right. No, I mean, obviously they can do that. But the question is, did they make it more efficient? And I suspect they did. Or
I
they
asked them
could.
the question whether how it cost them.
Disorganized this morning.
You know what I'm saying? So
I am very cynical about these things.
yeah.
ECF.
I would have liked to ask them if they have their
Good morning.
Good morning. How are you
Could-
today?
Fine. Could you please introduce yourself and
Sure.
everybody that's here with you?
Sure. My name is Jennifer Maldonado. I am the executive director.
Camille, I don't know if it's on.
It is on.
Ah.
Oh, shall I?
You have to get closer then.
Closer?
is this
How's that?
Easier.
Better? Good morning. My name is Jennifer Maldonado, and I am the executive director of the Educational Construction Fund, also known as ECF. I'll have the folks to my right introduce themselves.
My name is Cynthia Wong. My name is Cynthia Wong. I'm the Director of Finance of the New York City Educational Construction Fund.
I'm Warren Ruppel, the engagement partner for Marks Paneth.
Dan Macquey, Engagement Manager for Marks Paneth.
Thank you very much for having us here this morning. It's always a pleasure to meet with you each year. ECF is, I'm sorry, lost my train of thought there. So ECF did very well this year. Our net position decreased, although by approximately $21.3 million during fiscal year 2019, followed by increases of $25 million and $12.9 million in previous years. This was due in part to, in April of 2019, the fund made a distribution to the New York City Department of Education, DOE, of $35 million. Absent that DOE distribution, the fund's net position would have shown an increase of $13.7 million. In recent years, the fund received one-time participation payments associated with the sale of condominium units at 250 East 57th Street. In connection with the sales from fiscal year 2018, and 17, the fund received participation distributions of $1.6 million, $18 million, and $10 million, respectively, from the developer. The developer has almost finished closing sales on the residential towers condominium units, which began in March 2017, and thus future condominium participation payments for the project will be minimal going forward. In fiscal year 2019, the fund's rental income and tax equivalency revenues from its existing properties grew from $27 million to $28 million. In October 2018, the fund refunded its 2007 A bonds at favorable pricing levels, achieving net present value savings of approximately $6.9 million, or 14.39%. The bond refunding transaction, issuing $40 million of 2018 A bonds, had strong market interest with many bidders. In September 2018, the New York City Council approved the ECF project at Khalil Gibran, which will include the construction of a new high school and new District K5. The demolition and townhouse portion was completed this summer, and we anticipate issuing bonds for the construction of the project in March 2020, next month. Our co-op tech project has been delayed through an appeal process of the Article 78 lawsuit that we prevailed on, but the plaintiffs have been successful in extending the appeal period. We hope that we're able to find some resolution to that this year. Our developer continues to be committed, as does the community, to the project. We also issued an RFEI for the rehabilitation of our school located at 131 Avenue of the Americas, and we hope to sign a term sheet and begin that project within the next few months. Marks Paneth can talk about the accounting treatment of the refunding, reduction in OPEM expenses, et cetera, anything that you have questions about. So I'll open the table.
Yeah, I don't have any specific comments. I mean, the accounting for the refunding was, typical. And, we had no management letter comments this year for this entity either.
On page 11, you have your completed projects. is there a listing of current projects in work, that you're
In the
currently-
works.
Yeah.
We can include that going forward next year. Our projects that are in process are our Khalil Gibran project, which we will be issuing bonds on next month. And then we have another project that we're just in its infancy, but we can, going forward, put
So
projects
those are-
in process.
Those are the only two projects?
And our Co-op Tech project, which has been mired in
Yeah, I'm
Article
not-
78.
I guess I'm not looking
But it's-
to put in here
Yeah.
projects that you're in negotiation for.
Okay.
Because that could affect a lot of things.
Correct.
Just
Going forward, we'll put those projects that are sort of in process and fully baked, for lack of a better word.
Larry?
The 35 million you transferred over to DOE, is that unique or at least unusual, or is that a regular part of your doing business?
It is very unique. It's only happened one other time in our history. The New York City education construction law does say that we can make payments to the DOE when requested, but that has not typically happened. So I would tell you the last time this happened was probably about 15 or so years ago.
And do you plan to make regular payments or just on the request of O&B?
Absolutely not. Only on the request of
Request of
OMB.
DOE, rather.
Exactly, yeah. Only on request.
Thank you.
If you turn to page 5, under the table, it says associated with these two projects. I couldn't figure out which two projects you were talking about.
On page 5, the fund capitalized within the site.
Right under the
I
table.
see what you're saying. It's associated with these two projects. I'm not sure which projects were.
It's related to the 80 Flatbush and the Co-op Tech projects. Sorry, it got split, the table got split, so it's referring to the two paragraphs before. on
Okay,
page.
well,
So it's-
Speak into the microphone.
that makes
It's related to the 80 Flatbush Khalil Gibran project and the Co-op Tech project on the page
not any of the
before.
others. Okay. Then if you turn to page 6, you have operating expenses, and you have bond issuance cost as an operating expense. Is that appropriate?
I'm going to turn this over to our accountants here.
Under operating expenses, you have bond issuance expense costs.
Well, they didn't have a separate category for non-operating expenses other than the DOE transfer,
just-
which
it was the only place to
kind
put
of
it, huh?
wanted to put it as kind of a below-the-line item. So that was the only one that was broken out.
Okay.
It's not a normal course of business
No, I know that.
action.
They're an operating,
so-
they're a financing authority, so it
Yeah,
could
I
be
mean, it was
considered.
never inappropriate to call them
Yeah.
operating, but the reason why we didn't really think about even putting them down below the line is because we wanted that below the line piece just to be the
Okay.
DOE.
I understand now. Now, this is just because I didn't understand it. It says DOE will add stripping.
Which page?
11. What is stripping? Your page 11 says DOE will add stripping so that neighborhood schools.
The last sentence in the paragraph
what
that
does that
starts
tell me?
co-op.
Striping, so that
Striping.
it's supposed
No,
to be
I read it as
striping, so
stripping.
that neighborhood schools may utilize the space until demolition begins. That's just an issue of there is a piece of this playground that had been used by MTA over the course of the Second Avenue subway maintenance. So in order to, they've now vacated that property, so in order to use that playground for neighboring children, there'll be some low-level striping that'll be added to that piece of property until
so
it's
that's what striping
used.
means.
Striping.
Okay.
That's what striping means. Yeah, I'm not sure what stripping would be. So I don't know
That's
what
what
I'm
threw me off. That kind of threw me off. Then on page 16, the net pension liability doubles from year to year. I assume that's the result of some actuarial change?
Yes.
There was a change where one of our former employees, their child was previously treated by mistake as a spouse. So that was corrected. So that assumption was corrected by the actuary, and that is what resulted in the change.
How would that enter into a pension liability then? That's health benefit.
That's the OPEB liability.
That's
Well,
okay.
the OPEB is one
Oh, I'm
thing.
sorry,
Actually, the
you're talking
OPEB
about a
went
different
down,
one.
but the pension liability doubled.
Right here.
I don't know, it's just the number, those big percentage changes. If you look at this from somebody who's looking at this, trying to understand, you can't figure out what happened.
Yeah, they're part of the cost sharing, the New York State Employee Retirement System, so they're basically given their proportionate share of the various liability and expense.
Well, from the standpoint of a reader then, would it be nice to say that we don't control this number and the fluctuations are whatever they are?
That could certainly be added.
If you look at it that way. And then, when we talk about, when you use the use of estimates, you refer to the other post-employment health care benefits. Actual results could differ from estimate. Why don't you refer to the pension plan estimates would have some impact here? Why only OPEB?
I guess, pension could be added.
I'm only asking why you chose to leave it out when you mentioned OPEB.
Because in the pension case, it's not really not management selecting the estimates, it's really the state and the state retirement system doing making the estimates.
Wouldn't the same thing?
But it's still an estimate, so it could be added.
I'll just point that out. Now, in investments, you say U.S. Treasury or other government, that's U.S. government, I assume.
Yes.
And then on H, you say bond issuance costs are recognized as costs in the period incurred. So when you get an issue out, you take all the costs in that year?
Correct.
Or you don't amortize them over the life of the bond?
No.
Yeah, no, that was a change a few years ago under GASB 65, I believe, that they became.
You take it all at once?
Yes.
You don't, huh? Shows you I'm out of the business. Yeah, I'll give you the warrant. There are a couple places where you use a comma too. Sorry.
Warren wanted to know about the thus.
And then,
I was waiting for the comma. There's always a comma
I'll give you
or
a
a
few.
semicolon that we're missing.
all right.
Are there any other questions or comments? I thank you for coming this morning.
Thank you very much.
Have a good
See
day.
you next year.
God willing.
I'll take that.
Really?
Yeah,
Sorry.
good dance. That's all right. One less thing for you.
Look, anytime you have to lose money, somebody wants it.
Next up is the School Construction Authority, SCA.
You know, I used to be in the business of selling bonds. And
After you printed them.
when I was, first time around as a lawyer, I issued the bonds, and then I bought and sold them.
And then you refinanced them?
That was Milton's great contribution, one of them, you know. And then he got, nobody's ever focused. I still haven't made a deal with the water supply people. Okay, we'll talk later.
Good morning. Could you please introduce yourselves?
Hi, School Construction Authority. I am Marianne Egri. I am the Vice President of Finance and Human Resources. With me today is Steve Lowitz. He is our Executive Vice President. Ewen Wang, our Director of Accounting Operations, and Mark Spaneth, Warren, who you know well, and Dan, who you also know. Okay.
Thank you.
So as a basic introduction, so in 2019, we committed $3.9 billion. And that included construction contract awards for 30 new schools with a construction value of $814 million. And also construction contract awards for 544 capital improvement projects with a construction value of $1.5 billion. In 2019, we completed 18 new schools, and we added 3,992 seats to the school system. Currently in construction, we have 56 capacity projects, and we have 1,174 capital improvement projects. And for this year, we're on track to open 22 new schools and adds over 7,000 new seats to the school district. And as you know, last year was the fifth and our last year of the 6th five-year plan, and we are now in our 7th five-year plan, which is funded at $18.7 billion. That's it. Yes. That's it.
I have been told by a couple of people in the real estate business that the demand for skilled trades is such in the city now that all construction either is going up in cost or hard to get done. Does that apply to you as well?
So yes, generally. You look at the skyline and you see construction, and we're competing for the same resources as other public and private sector construction activity throughout the region. That's why we push hard every year, including this year, to find new contractors, especially electricians and plumbers and those who can work on the many smaller jobs that we have, as opposed to new school construction and larger rehab projects.
Can I go, Mike?
Yes.
When you have retainage, where you hold...
Page.
It's page, I guess, 5. It focused on it. You hold certain things as in lieu of cash retainage. You hold people deposit securities with you and that. Who watches the margin on that?
Ewen does, our accounting department does.
You watch the fluctuations
Yes.
of the underlying securities?
Yeah.
Okay. There's a comment on page 6 that cash is secured through J.P. Morgan Chase. What is the word secure? You give them, what does that mean, cash is secured?
So basically, the FDIC insures a certain portion, and so anything in excess of the FDIC insured portion are collateralized in U.S. Treasury that J.P. Morgan holds on our behalf in order to secure the excess cash amount.
So what this is, it isn't secured through what you do is you have J.P. Morgan as the custodian of that asset, and they watch over whether it's what it is. I don't understand the concept is secured through.
So basically, J.P. Morgan purchases the U.S. Treasury notes on our behalf in order to secure the cash that's currently held in their bank. So should they ever default, the securities would in place be substituting.
So they have Treasury securities collateralizing your bank balance, is that it?
Correct. In place of our bank balance, yes.
I understand. Well, the language is a little different than I'm accustomed to seeing
We
about
could-
collateralized deposits, if that's what this is.
We could adjust it next year.
It's not the way it's usually said.
Hi, you're going to recognize this question as very familiar because I've never understood it, so help me. So you have capital expenditure of about, oh, I'm sorry, page 7. So you have capital expenditure of 2.5 billion in 19. How much of this current 5-year plan will end up being paid for in the next 5-year plan?
So, how much of...
You remember that question I always had. So there'll be some portion of this 5-year plan
Right.
that will be committed in the 5-year plan, but actually paid for in the next 5-year plan. About how much will that be? Can you estimate?
No, I wouldn't know the exact number. I mean, basically, we commit the full construction contract when we award the contract, but change orders are committed as they come along. So they would be, so if you committed a construction contract in the last year of this plan, or even in the last year of this plan, then those change orders would be materializing in the following year, and it would be the number that we're carrying as completion costs. That would be the most representative in the 5-year plan. I'm not sure what that number is right now. It would be whatever is in the new 5-year plan that we're carrying as completion costs.
That's completion costs. Okay. Okay, and so it's only change orders?
No, well, furniture, so on a capacity project, furniture, you wouldn't be ordering your furniture until the school is ready to open, so it would be primarily change orders, and furniture would be the major components of those things, of completion costs.
Okay, thanks, now I understand it.
On page 8, you have something else I couldn't figure out. In the first sentence, it says, favorable insurance actuarial valuation of claims. You have actuaries who are evaluating claims?
Correct, for the insurance, yes.
So they do the evaluation of, say, somebody's hurt, and they tell you how much it's going to cost?
So they do evaluation of what they would think of claims that haven't been reported and the future payout of a claim. So these are construction-related claims.
So this is their estimate of what's likely to be claims that come in rather than actual claims?
Correct, yes.
Oh. Okay. I guess on page 10, there's a very substantial reduction again of the pension and OPEB year on year. That was done because the actuaries came in and that was based on an actuarial revision of the assumptions?
It's based on the actual valuation for the pensions, correct?
Not the OPEB? Must have been both.
The main reduction is actually pertaining to the pension side of it. So I believe this year the plan assets were favorable to the pension plan itself. So
My problem with the mixing of pension and OPEB, pension gets partially, money goes into the pension plan every year.
Correct.
OPEB gets nothing.
Correct.
So you're mixing two different kinds of things here. One where actual cash is put into the pension plan, and the other one where it's all notional. You think it would be appropriate to break that out?
Okay.
Well, the way the OPEBs work now, that's pretty much on the same basis as the pension is under GASB 75, so...
No, I understand that.
Yeah.
But the fact is, city puts certain amount of money in every year in the pension plan and puts nothing in OPEB. And so when you put them on the same line, that difference is not made available to a reader. It's one of the big problems in the city financial statements. OPEB is this $100 billion monster with no cash. And the pension plans are funded partly. I think it's a bit...
I mean, the actual liability, if you look at the balance sheet on the page before, the pension and the OPEB liability are reported
No,
separately.
I understand.
Yeah. But not the expense, which we,
It's kind of magical way of making that thing not appear as bad as it is. Now, I have a question I meant to ask all the others. Do you folks each have an independent audit committee?
Yes.
And they've been through this
Yes.
contemporaneously? One of the things I find troublesome here is we're looking at this in June 19, and here it is, first quarter of 20 is almost over. And so we can have no, other than catching some little stuff, we don't make much of a contribution. I don't know how we ever deal with this. I've said it many times. I don't mind repeating it again. The idea that we as a committee get this thing to find the minutia that we do and have no impact on anything is kind of not the way I would like to see it done. I don't know how we ever do it under the timing. And I've talked about it before, but I resolved I was going to mention it today again.
This is an issue that we should be taking up.
Another way.
In another way, another time.
But it is comforting to know that you have an active...
Giving us input in terms of
For next year.
how we format the books next year.
No, all right, enough. I mean, I don't want to be on the wreck. All right.
You have any more?
Well, on page 15, you refer to fund balances that cannot be spent because they're not in spendable form. What are those?
Inventory.
The last line on the page.
non-spendable fund balances would be like prepaid expenses or supplies.
No more. I'm going to move on.
No, I can't. The rest you can look at my handwriting and figure out.
If there are no other questions or comments, thank you very much for coming this morning, and have a good day.
Okay.
Thank you.
You finished?
I'm finished for today.
Wait, I got to talk to you for 1 minute.
Yeah.
Yikes.
Who should go first? DOE about the management letter or Grant about the management letter? For DOE. No, I'm saying, which comes first, the chicken or the egg?
Did you want Grant Party to make a statement?
Yeah, that's what, the issues, except for one comment, and then I like to turn it over to DOE.
To expand on it? Okay. All right, and then DIIT will give their spiel on birds.
I'll forget. Rich Carlo.
We go into executive session?
Wasn't she sick?
I think she went to the
Oh,
restroom.
you weren't here. Oh, you were on sabbatical.
Yeah. I stuck it in here somehow.
Lived in the house 4 years. Just give Mark a minute to come back. We're just going to wait 1 minute, Mark. And didn't even know he got up.
That one. That looks like it.
Stress.
That's it.
New house. Not a piece of cake, but a couple speed bumps. Meters didn't come in timely and things like that, but that's on track. It's mine now. Okay.
You give the wrong answer, you mean something.
Yeah. He used to be DEP at the water board.
sell this thing.
Okay, next up on the agenda is the Department of Education Management letter. And first, I'd like to hear from Grant Thornton about the letter, if you have any comments.
Of course. We've got Mike Ryan, Senior Manager on the Department of Education team here with us, so he'll provide a high-level summary.
Sure. Thank you, Marla. So we have, as it relates to the financial reporting and accounting policies and practices, we have identified two control deficiencies, which we've identified as significant deficiencies, and then also another two that we've identified as control deficiencies. So I'll go through them at a high level. Of course, if you have questions, just let us know. So the first one on page 2 of the letter relates to the accounting for fiduciary fund cash accounts. So based on our testing, we identified some of these cash accounts that weren't properly reconciled and recorded to the general ledger. Based on that, management went back, reviewed the rest of the balance, ultimately resulted in an aggregate reduction in cash and the related liability of approximately $1.2 million. So we've just recommended that the DOE look to strengthen the controls over the process of reviewing those accounts, as well as providing additional feedback and training to the schools that are reporting those balances up to the DOE.
I don't know.
Is that tax levy or is that not tax levy in those accounts?
It's not tax.
No.
It's not tax levy. It's like school fundraising money. It's money.
This is like GO money and the parent teachers organization.
Exactly. That's right.
The clubs, the groups.
That's exactly right.
It's all, how could I say, money's being held in a fiduciary capacity on behalf of somebody else.
That's right.
The trouble is nobody who watches those monies and how they're being spent, and it's up to those folks.
I was always bad apple or two in them.
Oh, yeah.
We have chancellor regulations that govern the spending of bank account funds.
Okay. So the
I just have one more quick. So does every school have one of these accounts, or do schools sometimes have multiple accounts?
Sometimes schools have multiple accounts. Several years ago, schools had many more of these bank accounts. We've been working on a process to ensure that schools close these bank accounts as is appropriate. When we were collecting lunch money from students, schools used to have a dedicated school lunch bank account to deposit these funds. And since we now have free lunch for all students, we have been closing those accounts systematically.
When they open up the accounts, do they obtain their own tax ID, or are they using the city's tax ID?
They should be using the city's tax ID or the Department of Education.
Correct, it's the same, we share it.
Yes.
The same one.
Mm-hmm.
Okay. So the second finding we have here relates to accounting for capital assets. So during 2019, the DOE, along with the SCA, in performing their year-end review over capital assets, identified that approximately $1.5 billion worth of capital assets that were physically placed in service in prior years were not transferred out of the CIP construction in progress balance on their within their accounting system, and therefore had not been depreciated. So what the DOE did was they performed a detailed review over all of their assets, made sure that everything was coded correctly to the right capital asset category, and brought depreciation up to speed based on when those assets were physically placed into service. So based on that, we recommended that they just improve communications with SCA and just improve the process and procedures over reviewing capital assets, making sure things are being transferred over at the time that they are physically placed into service.
About how much depreciation wasn't recorded because of this?
$1 billion. I think it was 1.1.
Big number.
That's 1.1 billion in depreciation based on 1.5 of capital assets?
Correct.
So it was apparently quite a while this was going on.
Correct.
Yep.
Yeah, I meant to ask SCA the question that this was actually in their CIP, not on the city side. Am I correct?
The buildings, the computer labs, they were sitting in construction in process when they shouldn't have.
On SCA's books.
On this, in FMS, in the city's books as well. So in August, pursuant to the controller's fiscal audit close, we have to make a certification to what's in inventory. So we had to do a catch-up, and that was done in August of last year, last summer, where we made sure that all the items that were sitting in construction process for a long time, they had to be uniquely identified. So there was a workaround. Instead of saying building 1, 2, 3, we categorized them and we were able to identify them. And then with assurance, we were able to say these were actually placed in service, but we never transferred it over as a depreciable asset on the DOE's books. So that was a one-time catch-up. It puts us in a better position for implementing the GASB 87 in FY '21. But yes, it was a timing issue, and it was a major catch-up.
Are some of those buildings still in service?
Nothing was stolen. It's just didn't go from one account to the other account.
Some of those buildings fully depreciated?
25 years. I don't know fully, but a good chunk of it must have been.
So we were talking about a significant number of buildings or structures.
Correct.
Yes.
All right. Jump around a little bit on the letters before I hand it over to Hassan to cover some of the IT findings. So on page 5, so these are both control deficiencies and similar to findings that we had in the prior year. So the first one relates to employee time entry. So in doing some of our testing over employee compensation and time entry itself, we identified that while management does have policies and procedures in place to ensure that that require timely submission and approval of time entry, we did identify certain instances where the approvals were not taking place on a timely basis. And so we just recommended that DOE look to strengthen those procedures to make sure that all timesheets are approved on a timely basis. And then the second item here relates to accounts receivable write-off. So the DOE does carry a significant receivable balance, and they are actively writing those balances off as they identify the issues with certain receivables. However, they have not established an allowance for doubtful accounts, using historical balances and looking to see where they might have potential troubled accounts in the future. So we've just recommended that they look to do that going forward.
Yeah, two issues with this. One is, what is the payable write-off that corresponds to the receivable? Because typically in the past, they've always booked a liability as well as a receivable. So if they wrote off the receivables, what was the write-off on the payables?
We try to do a concomitant. It may not be a one-to-one. We do a bottom line, below the line adjustment for prior year payables that were written down, and that is below the line on the financials. In terms of addressing this finding, I know the city does the allowance and the reserve
That was my
citywide.
second.
So the agreement was, we're working with the controller's office and with OMB to identify that portion, which represents just purely the DOE's portion, and then we'll reflect that on our financial statements separately.
Yeah. But your question is, it's just not reflected on their financial statements, but
Correct.
they are part of the citywide allowance that gets set up.
Right, that portion is
Yeah.
being transferred over to the DOE's books. Correct.
On the entry of time, I'm taking it that there's work locations that we don't have access to the system. What kind of locations are we talking about?
These are mostly administrative buildings for managerial administrative folks. It could be some mostly managerial attorneys.
They don't have access to the system there?
Oh, they have access to.
Because the implication here was that there was lack of access, I thought.
It's not access. It wasn't timely reviews and approvals.
Yeah, it's actually the time, it's actually the timeliness of the entry,
Of
so.
entry into the system.
Into the system.
They have the system there, they could do it, they just didn't.
They didn't, in a timely
Housekeeping.
fashion. So we're taking steps now to create reports on a quarterly basis to send to supervisors to,
And there's
to
no
approve.
paper involved here. These people should be able to go right into the system where they're working, enter their time.
That's correct.
Okay.
Anybody else have any questions or comments or issues?
One thing leaps out, this has been going on for a long time. It's the first we've heard of it before this committee, am I right?
Which one? The
problems of the ones before that, the write-offs and the write-ons and that sort of thing.
The
It's been-
depreciation?
Depreciation going on for a long time. I mean, is there something we should be concerned about that we never heard about it before?
Well, that's why GT was pointing it out as a significant matter. It's not that the processes weren't happening, it just wasn't done timely. We normally work with SCA and other parties within the DOE. We do our reconciliations. We have procedures in place, but it's more done towards the end of the year. It's a little too late in August when we have to certify to the city, these are what we have as capital, as depreciable assets, this is what we have in inventory. So to address that, we're out of sight, out of mind is not such a good thing. We have separation of duties, but what we're going to do instead is internally meet and upload data into FMS in April. So we'll have less of a window to reconcile. So that's the improvement that we're doing to address that.
Now, I guess what I was concerned about manifesting, somebody said this has been going on for a while, more than just this fiscal year.
Yep.
And I'm wondering why it never got to the audit committee before, if it's this significant.
We hadn't identified it previously. It was through the reconciliation process that took place this year when the significance of the issue was identified.
Better late than never.
Well, you just keep your fingers crossed there aren't other issues
Yes.
like that which haven't yet been
Not to that
found.
extent, not to that extent. And we have more procedures in place to uniquely identify the buildings, so construction and process should be really true construction and process and not overinflated. So we feel we're in a better position than we were years ago.
You had mentioned IT.
Yeah, so we'll turn it over to Hassan for a couple of IT issues.
Thank you, Mike. Good morning, everybody. I'll go over items 3 and 4. For the committee's edification, there were 2 systems that we considered in scope for the Department of Education. Famous is a general ledger, and Galaxy is used for budgeting purposes. Item number 3 is specific to Famous only. And really what it alludes to, that through our termination sample testing that we conducted, so we picked 25 terminations, we noted that 9 of those 25 retained access to Famous post their termination date. However, it's important to note that 8 of those 9 were marked for deletion, and really what that does within the system is that it doesn't allow or doesn't permit for any transaction to flow through with that user ID, and you can't really access the application. The risk is that these IDs could be turned on if they haven't been deleted completely from the system itself. Those were 8 of the 9. For the remaining 1, there was really a discrepancy between the person's employee ID and the ID within Famous itself. Moving forward, management has a great plan in place that the systemic, I guess, reconciliation really between the employee ID and the system ID will be taken care of. This hopefully will not occur again in fiscal 20. Any questions that I can help address for this specific finding? Great. The second part of the same finding, number 3, at the top of page 4, there was just one employee's name that we were unable to locate in the active employee listing. I guess a similar concern that the person in question here was using his preferred name and not the name that shows up in the HR system. So if my name is Hassan, I go by HK, that's really where the discrepancy came in. This too, there's now a systemic process that the employee IDs will match up with the system IDs. This too should not occur again. Great. And number 4, the last item on this letter, it's fairly wordy, but really what the user access review finding what is alluding to is that on a consistent and formalized basis, management has not looked at who has access to what within Famous and Galaxy. Now they do perform this user access entitlement review. It's on an ad hoc basis. We didn't really have the documentation evidencing that, yes, it was done appropriately throughout the course of the year. Just moving forward, the management is looking for a way to automate this process, which will simplify some of the documentation and should hopefully remediate this risk completely. Any questions?
Does DOE have any comments?
You?
Thanks.
I remember, it's probably not for these people, but it seemed to me in a number of the letters, there was talk about getting insurance against this.
Yeah, that's the next question, because at the last audit committee meeting, a question came up with BERS about cyber insurance. And as I understand it, somebody's here from, to address that issue.
Sure.
So you're that somebody.
Yes, hi, I'm Michael Jabor, Chief Technology Officer.
I don't know.
Can you hear me now?
Yes.
Okay. So Michael Jabor, currently serving as Chief Technology Officer. We contacted Citywide Cyber about the need for cyber insurance, and the guidance from cyber was that the city is self-insured as it relates to cyber incidents. So the recommendation was not to proceed with acquiring a specific cyber insurance policy. So that was the due diligence that we did and the answer we got.
As somebody who has had to deal with this problem as the director of a couple of companies which got hit, one advantage that you lacked then is that in each of these cases, when we called the carrier was helpful in resolving the problem for us. They have a list of counsel that specialize in dealing with cyber risk, and in effect, they were able to intermediate between us and the FBI and the local police force. And so there's a small benefit, but not inconsequential, of having the insurance. Does the city group have the same kind of know-how that you could rely upon if, as I'm certain it'll happen, some of these people will be hit?
So we made that exact comment to cyber, and their response was the same, which is that they feel the city has what it needs in order to address those risks as they come up.
Mark, just to address that, I did have subsequent conversations with the law department with regards to the city's overall cyber policy, and so that's something that we'll discuss in executive session.
Okay.
But with regards to your comment, since the city is self-insured, I'm assuming that BERS, because they're part of DIIT's structure, IT infrastructure, that they too are covered.
So there's an interesting relationship with BRRS. They don't report to me necessarily, and from a technology perspective, we provide some services to them, but it's more of outsourced services. So while they might comply with certain policies and procedures and service policies and procedures that IT has in place, they don't technically report into our unit. And so I don't know the nuance of how, whether they would be or would not be covered in that context.
Thank you.
Is this about the test? Okay, let me call you back.
Good luck.
Thank you.
Sorry about that.
Well, it's interesting, the FBI in effect said you better, they wouldn't tell you that, but they tell you to pay off so you get back into business.
If there are no other comments or questions, thank you for coming.
Thank you.
Yeah. At this point, I'd like to take a 5-minute break before we go into executive session.
Where the hell is it?
Okay, I'd like to call the meeting back into order and entertain a motion to go into executive session.
Motion to go into executive session.
Okay, we're going to move into,
Just in case. They were ready, he's ready when, okay.
okay. I'd like to make a motion that we adjourn executive session and go into open session. If there's no other further business, I'd like to entertain a motion to adjourn today's audit committee meeting. Thank you.